Hello everyone, welcome to Citadel's second webinar. On behalf of Maggie, Simone and myself, we'd like to welcome you to a special webinar which we've got organised with Blake Henricks from Firetrail is going to present. Now, this particular year has been obviously a year that we'd love to forget. Started off with the bushfires, which were pretty horrific. And then we've had the coronavirus, which hopefully we may have it under control at this particular point, but all we have to do is look at Europe and look at other areas around the world that it's extremely difficult to do that. And let's hope that you're all well and you're all got your love and support with you, and hopefully we can get through all this together. And I'm sure we've heard that before. Okay, so yes, so this particular webinar, we usually at this time of the year have our normal function. Okay, so it's normally an exciting time. We're usually have about 100 of us getting together, and we'll have speakers like Blake. He's actually spoken to a few of our seminars. So, but we're not able to do that obviously because of the coronavirus, and we've decided that we're going to do a number of webinars, and which we're pretty excited about. So, and this particular webinar, we obviously the topics are investment markets, sort of global economic situation. So in this particular webinar, it's just mainly about investment markets in Australia. So we've got a special guest, which is Blake, and as I've mentioned before, a number of you have met Blake, and he's presented, and I know from the feedback that we received that he's one of our favourite speakers. So it's great that we can get him back. Okay, and just a little bit of history of Blake. He previously managed the Macquarie High Conviction Fund, and we had the Macquarie High Conviction Fund in our model portfolio for quite a number of years. And it's been a very successful fund. It's performed quite well. It's averaged, it looks like Blake has mentioned, it's averaged about 10.6% since inception. Okay, that was net of fees. So it's a very, very successful fund. And but in 2017, Blake and his team left, and they decided to set up their own fund, which was Firetrail. And of course, we like to follow where all the good managers go, and we have Firetrail in our model portfolio today, which is fantastic. So we're very pleased to manage to get Blake to do this webinar. So we're pretty excited about that. Now he is, I'll just give you a bit of an update, just looking it up. He's had 18 years experience, okay, which is good. We'd like people with lots of experience. He is the Deputy Managing Director of Firetrail High Conviction Fund. So, and also I've mentioned his history, his background, where he's used to manage the Macquarie High Conviction Fund. So I'd like to welcome Blake, and we're going to start off with a few questions. Okay, so the first question I'd like to ask Blake is, market conditions have been challenging and uncertain for investors. What are the key themes you see across equity markets today?
Yeah, very good question, John. And can I first also say thank you very much for having me. It's always such a pleasure to present at your sessions with your clients. I particularly I've felt like the best one has been the magician so far. So as a big fan of magic, I am also particularly sad about what COVID's done for all of us. But thank you so much for having me along, and hello to all your clients who are watching today. I'll also apologise in advance. I am working from home today. I recently had some surgery, and I've got a dog who loves to bark. So if I do go on mute, apologies for that in advance. But let's get into it. You are right. It's great. Really uncertain times at the moment. And I think one of the most interesting things, despite how bad things have been, the markets have actually been quite resilient. Sold off heavily in March and bounced all the way back. And one of the big reasons for that is just how much government support there's been out there. Now, what you can see on the screen at the moment, what we've done at Firetrail is actually added up all the government support by quarter and plotted it. And what you can see is that in September, there was over $100 billion of stimulus that went into the economy in the form of those super withdrawals, the JobKeeper, support for business, support for households, and also the mortgage deferrals. So I think what we've seen really, and it's very important to understand, is just how much government support has been out there. I think we have seen the peak now. Call it Super September. That was when, you know, JB Hi-Fi, Bunnings, they're doing 40% sales growth during that quarter. You know, it's a massive quarter, but I think that is the reason why the markets have been stronger than many of us would have expected because of that government support. Now, the second thing I think it is worth mentioning, one of the biggest winners out of everything going on is, very surprisingly, the housing market. Now, on this slide, what you can see is what we call monetary plus fiscal. What that means in really basic terms, monetary is interest rates, and that is interest rates being very low. Many central banks out there are saying rates are going to stay at or close to zero for the next 3 years minimum, right? So people are feeling like, wow, rates are going to be very low for a long time. The second part is fiscal, and what that is the money being dropped into people's accounts. It's stamp duty cuts in certain areas. In Australia, we've got the home builder subsidies going through, and what it's causing is a global housing boom. And it's, you know, if you had have told anyone in March we're about to go into a global housing boom, you would have said they're absolutely crazy given everything going on. But that's what we're seeing. I've shared two charts here. The first one is UK mortgage approvals spiked to the highest levels since pre-GFC. On the right-hand side, this is REA data, so realestate.com.au. How many of you are searching? I'm sure in Melbourne, probably all of you, something else to do while you're locked up. But you can just see how many people are getting interested in property because of low interest rates and also that fiscal stimulus. So I could have put up charts here from the US, from Brazil. Around the world, we are in a global housing boom driven by everything that's going on, which is quite surprising. And the third thing, it wouldn't be a presentation at this time without talking about COVID. And so we are seeing, and you mentioned it up front, John, you know, what we're seeing in Europe, the COVID impacts are diverging globally. The chart on the left there shows you cases per 1,000. And I think what's been interesting is we all had a first wave. US then had a second wave. It's actually come off a bit since then. Australia has been lucky. If you're in Melbourne, you don't agree with me, and I would agree with that. But, you know, overall, if you do look at those cases per 1,000, Australia has been quite low in aggregate. But you look at the UK, it's going very, very high at the moment in a second wave. It's really important to think about what happened to the market the first time. You know, with that first wave, the market's dropped close to 30%. With the second wave, the markets have actually been very resilient. There's two reasons for that. The first one is people are getting very comfortable. The government's going to put their hand in their pocket and continue to stimulate where required. And the second part is, this is good news, the death rate is much lower this time around. I haven't put this data in, but you know, there is a lot of data behind it, and it is suggesting the death rate this time is much lower. Sales of ventilators have been way down. Hospitals are saying we've actually got enough ventilators now. We're feeling pretty good about managing this. So, you know, cases are rising globally, but there is some reasons for optimism. And I think the biggest reason for optimism is on the right. This is Seek job ads. So this is how many jobs, you know, the average business is putting out there looking for new people. And what you can see is those states that are open, SA, Queensland, WA, they're actually back to pre-COVID levels in terms of job ads. So what that's telling us is the money that was supported by the government has allowed those businesses to stay open. And as things come back, they're actually being able to employ again. You can see New South Wales is off the boil, and obviously Victoria in lockdown is off as well. But we would expect as the economy opens up, these job ads can go back. And that's why the markets have been stronger than many of us would have felt like they should have been. So those are really the big three things we're seeing out there in the market at the moment.
Okay, so do you think, you know, the debt that's been built up by the government, is that a concern?
I think yes, in short, it is. I don't know if there was an alternative,
Yeah.
you know, whether you have pain today or pain tomorrow, because that's, you know, what debt is effectively. You know, I think the alternative course of action, which was to let it run its course, have all kinds of bankruptcies, you know, we would have been effectively in a depression. And, you know, at that time in March, you know, that's what we were facing if the government didn't step in. Where it's going to become an issue is how and when is it going to be paid back? Because one thing we know about interest rates is they don't stay in one spot. You know, they do move around. Yes, they've been low for a long time. Yes, they've been going lower for a long time, but it's not inconceivable. At some point in time, interest rates will have to go up again, and that's going to cause a fair bit of pain for everyone. We don't know when that's going to be. It's probably not the next 6 months. It may not even be the next year. But down the track, we're going to have to pay this debt back. So that debt is going to be paid back, in our view, by taxes over time. So this is not something to worry about right now, but certainly on the horizon, debt has to be paid back, and usually that will come in the form of either lower spending or higher taxes for consumers and companies.
Yeah. Okay, Blake, just a question. Can you run us through the Firetrail investment philosophy that sort of guides, your decision making in the fund?
Yeah, for sure. Having an investment philosophy is like having a rudder in stormy seas. If you don't know what you're looking for, you'll be jumping at shadows, listening to social media, reading the papers, listening to your Uber driver, whatever it is. You've got to know what you believe, and you've got to know it well ahead of before you're investing. The philosophy at Firetrail, and I think this makes a lot of sense, is that every company has a price. I've just put up a slide in front of you, which is the better investment, the old shack or the harbourside mansion. Now, if I ask my wife, she says it's indisputable that the one on the right is the better one. But the key word is investment. That is absolutely the key word. And our strong view, every company has a price, is that the price you pay for an asset is one of the most important determinations in how much money you're going to make over time. And so sometimes, not all the time, but sometimes buying that old shack for cents in the dollar is much better than buying the harbourside mansion. You can overpay for certain assets, and so knowing the price of assets is absolutely critical whenever you're investing. And I think that's especially important today when we've got the likes of Afterpay and many hyped up stocks have done very, very well. But I think it's really important to always maintain that view of price, because the price you pay for an asset is going to determine the returns you get in the future. The way we actually do that is thinking about both what we call value and growth stocks, if you will. So a value stock is the one everyone hates. It's newspapers. It's at the moment it's TV, because we all know we're watching Netflix. It's taxis, because everyone's driving Ubers. And there's some people in the market who say, invest in those because people get too negative on them. On the other hand, you've got the growth stocks, and they're the ones, the Afterpays of the world. Gee, always invest in those because they're always going to be so good and they're going to be growing over the long term. In our view, we're pretty indifferent. We're happy to buy shacks and we're happy to buy harbourside mansions. But the really key thing is waiting for the opportunity when the market panics. So, whether it's an Afterpay or whether it's a newspaper stock, we want to wait for a time when the market really panics, because it always happens, whether it's regulation, whether it's something that's happened, an election, coronavirus, whatever it is. And so being patient, you can often see opportunities in both types of investments. And I think over time, what that means is you get smoother, more consistent returns for clients such as yourselves.
Yeah, okay, that's great. So how you uncover potential investment opportunities for the high conviction fund? How do you do that?
Yeah, so it really is about that, the whole growth versus value, going wherever those opportunities are. And a good example would be Seek, probably best illustrated through that kind of example. So I talked about, waiting for those opportunities. The big opportunity in Seek was job ads falling. Now, many of you know Seek. 20 years ago, they weren't around. They were just coming up. Today, if you need to hire someone, you have to put a job ad on Seek. And really the opportunity investing in Seek has been through COVID, because, as job ads have fallen, people have become negative on Seek and saying, well, job ads are down, that's going to be bad news for Seek. And, I can sympathize with that. That makes a lot of sense. But for an investor like us, we're looking at 3 years. We're not just looking at what's happening tomorrow or today. I think that's too short term. You need to be looking at longer than that. If you look out over 3 years, we can see job ads recovering. And what's been interesting is, as I mentioned up front, that job ads have recovered probably even faster than we would have thought. But what matters? It's the 80-20 rule. That's always what you need to do. Whenever you're looking at a company, my advice to you is think about what matters, because newspapers are sold based on news. They'll talk about plenty of things that don't matter. So my advice to you is, please, just if you're thinking about a stock, if you're thinking about anything in your life, just really focus in on what matters. And while many are talking about Seek and the low job ads today, what matters for Seek is that they are the only place to go if you need someone. they're not the only place to go. That's not true. Pardon me. But LinkedIn would be a good example. And so people say, well, gee, I don't think we're going to use Seek much anymore. I think we're going to use LinkedIn. We've done a lot of work on this topic. And what we found was that really interestingly, LinkedIn works well if you're hiring someone on $180,000 plus job. Usually that person is going to be, have high levels of skills. You're going to want to make sure you hire the right person. So you want to perhaps know them. But the average job in Australia, the median wage is $65,000. So if you're let's say you're a mechanic and one of your staff resigns today, they'll probably give you 4 weeks notice if you're lucky. That means you need a job ad on Seek that day, the day they resign, because you've got to go and hire someone who's also going to have to give notice. And unless you're willing to work without that staff member, you're in a lot of trouble if you don't put that job ad on the same day. And so I think that's why Seek is better than LinkedIn for the average job ad, because it's getting those active candidates who are looking. Whereas on LinkedIn, you can be going and talking to people who may not be interested in joining you. So what matters for Seek is they are the dominant place who fills job roles, and they are, the winners in that. I'll tell you the second thing that matters is that Seek is too cheap. That service they're providing is way, way, way undervalued. I'll give you an idea. So a $62,000 candidate is placed, as an example. If you used a recruiter, you're paying that recruiter, on average, about $9,000. It's a lot of money. 10 to 15% of first year salary on average is the going rate for a recruiter. You know how much that job ad on Seek costs that drives all the candidates coming through to that recruiter? $64. It's way too cheap. It's a great service. They've really been focused on making sure they fill the job roles first, but I think now we're going into a period where they're going to start charging what they need to for it. And so, if you step back and think about Seek, you've got a really dominant player. You've got the market being very concerned about job ads and overselling the stock. And at the same time, they're way undercharging for their product, and we're about to go into a period where they charge closer to fair value. So it's a really exciting proposition. But if you remember what I spoke about earlier, which was every company has a price, let's talk about price. What you can see here is the valuations. Now, this is what's called enterprise value to sales. Don't roll your eyes. Don't go to sleep on me. It's a really good metric for tech companies. It's a good metric because what we're seeing increasingly, the business model of tech companies is win market share and then price it later. The typical business model has always been to make money. For many years, that's been the case. But with the internet as it is these days, the business model is break even or lose money for 10 or 15 years. Once you've knocked out the competition, then go and turn the tap on. So what's really important is how big are your sales? How big is, how good is your business? And when you look at Seek versus a variety of other high growth businesses, whether it's Xero, who many of you know as an accounting platform, Afterpay, some of the others you may know, they're REA Group, realestate.com.au, car sales, Domain. Seek is one of the cheapest stocks in the Australian market, and yet has a dominant position and a massive pricing opportunity. So that's a really good example of a growth company. People have panicked, and that's created the opportunity. So that's how we think about investing in both value and growth stocks, and in that example, a growth stock.
Yeah, does Seek, it does generate quite a large percentage of its revenue from overseas. Is that correct? Like it's not solely, okay, it has a dominant space in Australia, and it does have a little bit of competition in Australia, but doesn't it, isn't it expanding quite widely into Asia? Is that correct?
Yeah, you're absolutely right, John. So, they've built this business, as I said, in 2000, I think it was founded in the year 2000 or maybe in the late 90s. But what they've done is they've now got this really great position across Southeast Asia. So they're number one in countries like Indonesia, Singapore, Hong Kong, Malaysia, Philippines, high numbers of workforce, low internet penetration. So some great growth stories there in Southeast Asia. They're actually equal number one in China, which is quite amazing, and have some Chinese partners up there. They've also got dominant positions in Mexico and Brazil, a little bit tougher markets at the moment, but they've done such a great job, not just in Australia, but around the world in getting these dominant positions. So you're absolutely right. It's not just an Australian story anymore.
Yep. Okay. Look, I've got a really good question here from a client. Due to COVID, do you think with what's happened, that manufacturing in Australia may get a boost with regards to, in particular, the medical products? And also, do you think China's approach to Australia, and China's obviously been fairly aggressive, do you think that may sort of slightly backfire on them, that maybe manufacturers in Australia may not look at China as a manufacturing hub in future and maybe manufacture in Australia?
Yeah, really insightful question. It's something we've been, talking about, thinking about. When we could travel, we were talking a lot about that throughout China, throughout the US, and throughout the rest of the world. If I just cover off on, what I think is really important is that China is a rising power. There's no doubt about that, and that's causing a lot of tension around the world. We started to see, really in the middle of the trade war, which was probably going back 18 months ago, which was when it was really heating up. I was talking to a lot of companies, and they were starting to say, we're nervous about having our supply chain in China. We're nervous about being over-reliant on having factories, especially high value strategic plans in China, and we're going to start replicating our supply chain. Now, immediately, some of the big winners were Taiwan, Vietnam, Mexico, because for companies, they still want very competitive labor prices, and so that's where they went initially. That was where sort of China lost on the incremental dollar. Now, we weren't actually seeing people shutting down Chinese factories specifically, but certainly as companies were expanding, they were doing it in the US and they were doing it in some of those countries I just mentioned. I think we are going to see it in Australia as well. And we're starting to see it on the defence side, where Australia is massively increasing our spend on defence in Australia. So, there's quite a few things I think to be concerned about on this front. And if we go into what's happening right now, China-Australia tensions are at an all-time low. There's just no doubt about it. We're having major issues getting meetings, diplomatic meetings with Chinese. We've spoken to former embassy officials, and they've just said, we are at rock bottom. Part of that was, politicians, including the Prime Minister, talking about, well, we want to do an inquiry into where coronavirus came from. We think it came from China. All those kind of things. And to be honest, those things aren't helpful. To say coronavirus came from a certain country or a certain place, it's not particularly helpful, and it's really upset China. Now, as a result, China's reacted quite forcefully. We've seen tariffs on barley, which has really hurt our farmers. We've seen China ban beef imports from 5 major Australian abattoirs, which has hurt our beef exports. They're looking at tariffs on Australian wines, saying that we're dumping those wines into China. That is not true in our view, particularly a company like Treasury Wines, who makes Penfolds. They're selling that wine for $300 plus a bottle in China. That is not being dumped, but this is political. And then the fourth one is a ban on coal exports. This was just announced just 2 weeks ago. So Australia-China diplomatic relationships are at an all-time low. We can actually look back through history, and we've seen these kind of things before. We saw it with China and Japan in 2011, when they had an argument about sovereignty of certain islands. And we actually saw it in 2017 between China and Korea. And the method is exactly the same. Really ramp up tension, really ramp up pressure, particularly on exporting industries, hurt that country, bring them back to the table, make them apologize, and then move on again. So I don't think it's totally broken, but I do think they are inflicting quite a bit of pain, and companies we know, CEOs are reflecting to the government, hey, this is a concern for us because Australia is an exporting nation, not only in physical commodities, agriculture, but also in terms of tourism. China could really hurt the Australian economy through tourism. In terms of the way, could it backfire on them? I think it could, but it'll be more, I think the biggest backfire will come from, because we're not a big investor in the Chinese economy. We don't have a lot of companies who have manufacturing facilities there. But I think where it will come back is that the whole world will start to say, well, this isn't okay. And, that has implications for China more broadly. I think we will see increases in domestic manufacturing, and this is around the world in response to trade tensions around the world. Even the US, the US has put a lot of sanctions on plenty of countries, particularly Europe. They had a fight between Boeing and Airbus. So I think increasingly we're going to have a bit of a deglobalization period where we see a lot of manufacturing replicated at home, in home countries.
Okay. We could go on and on about this subject, wouldn't we, Blake? But I think we might have to call it a day with regards to the webinar. And I'd like to thank you very much and appreciate yourself and joining us in this webinar. And also thanks for your whole team in helping us putting it together as well. Greatly appreciated. So thank you very much. And to our clients, if anyone would like to give us some feedback, that would be greatly appreciated. And thanks again for joining us, and hope you all are well and look after yourself during this difficult time. Thanks very much.